You've made a profit, your sales are up, yet somehow you can't pay your bills. You're staring at your bank account and asking, where's the cash? No. Is this a story that you're familiar with? Have you heard anyone sell this story? Well, I'll tell you, as a fractional CFO, I have heard this story more times than I can remember. Let me take you back to a conversation that I had with a client not long ago. And this client was profitable. The payroll was looming, taxes are due, and he couldn't afford his next inventory run. They called me frantically wondering, what do I do now? And here's the thing that most business owners don't realize until it's too late. Profit does not equal cash. You can be crushing your goals and still drowning. And today, we're going to talk about this. We're going to talk about how to combat it and how to transform the cash that you have in your business. Let's jump right in. And we're going to talk about Widget Co. This is an example that I took from a client I had, but I've changed all the numbers and things for simplicity's sake. But I want to talk to you about the levers that you can pull and the way that you can go about it. So let's jump right in. Widget Co. purchases 100 units of Widget A for $1,000 cash. That cash gone, boom, out the door. They do that on 4/30. They make their first sale 5 days later. That's great. But you know what? Here's the catch. They don't get paid for another 30 days. So we're going to show revenue and profit, but cash was untouched, right? And so they have to wait until they get that cash before they can do anything else. So then just a handful of days later, they sell 44 units, but they still have no cash because it hadn't been 30 days since that first purchase. So 44 units sold, 47 units sold, still no cash in the door for those units, meaning they only have 9 units left. This is the kicker here, and they don't have enough cash to rebuy inventory. So finally, we get to that 30-day mark. The first one, they've got $34 in the bank. Woo! This is amazing, right? Still not enough to rebuy inventory. So they got to wait another 30 days or close to it, almost 60 days from the initial inventory purchase. And they've finally got enough cash by $2 in the bank to purchase some more inventory. So as we think about this scenario, by the time the money comes in, they've barely got enough to restock their inventory, but they're now trapped in this vicious cycle of waiting for the sales to happen before they can buy the next thing. And the reality of this cycle is we think if we can just grow, if we can just get bigger, but for most, growth just makes that cycle even worse. And the hidden truth here is that growth just makes that cycle worse. Growth eats cash. Let me say it again. Growth eats cash. The faster we grow, the worse it gets. Sales speed up, inventory runs out faster, but the cash, we're still stuck in limbo for weeks or even months. As you scale, that hole that you're digging, the faster you scale, the deeper that hole gets, especially in low margin businesses. And we want to do and need to do better. So what is causing this issue? The reason we have this issue is because we have the lag between the purchase and getting paid. So you'll see we have 30 days from purchase from AR to 30 days of getting paid, which means 30 days more without cash to pay for the next round of inventory. In this scenario, we not only had this first section of over 30 days that we couldn't buy more inventory, we had, almost 45 days. And then we still, once we purchase again, have another period of time where we can't buy inventory. So what's the fix? How do we handle this? How do we approach it differently? And the answer to all of your problems here is understanding this concept that's called the cash conversion cycle. It's a simple formula. Really, it's 3 formulas in one, so not so simple. But when we explain it logically, it makes sense, and it's a simple formula, and we have a lot of levers that we can pull in ways that we can approach it to improve our cash conversion cycle. we have days inventory outstanding. So how long does it take us to sell our inventory? How long are we holding our inventory? That formula right there is going to tell you on average how long, how many days it's taking you to sell your inventory. Next, we're going to jump to days sales outstanding. It's how long until customers actually pay you, right? So if we look at that formula, we're going to say when you made the purchase to when the payment happened. How long is that? Is it 30 days? Is it 45 days? Do you collect it when they buy it at 0 days? Do you take deposits? Do you get it in advance? There's a lot of different ways to approach it and what that looks like. Next, we have days payable outstanding and how long do you take to pay your vendors? That vendor could be the supplier of the inventory, but it could also be other vendors in your circle. So this is telling how many days it takes to pay those vendors. That's compiled into this whole cash conversion cycle formula where we add inventory days, add receivable days, and subtract payable days because again, payable is the time that we're holding on to that money instead of them. And that is how many days it takes for you to go cash out for inventory to cash in on the backside. So, real simple at a high level, real complex as you get into the details. So, I want to go through some examples because I want to make sure that you feel comfortable with this concept. I have a client that shipped things from overseas, like so many businesses do these days, which means that it had to go on a boat and it took a long time for this inventory to get here. In their case, it took on average 185 days from getting on the boat to getting into their warehouse here in the United States. After it got into their warehouse, it took them 15 days to sell. So that meant that their average days inventory outstanding was 200 days, which is a long time to wait. It means when there's demand or fluctuating demand, you don't always know what you're going to need. And so that also then means you often have to hold more inventory than you otherwise would hope to. That supplier, not only did they take a long time to ship the goods to them, but they made them pay the day that they committed to the inventory and the day that it went on the water. So that meant that when they told the supplier that they wanted the inventory, they had to wait 185 days before they could even think about selling that inventory. So that means the supplier gave them 0 days to pay that payable. And then last but not least, they gave their customers 30 days to pay on the inventory that they sold them. And that was what the average came about to. So overall, we had 230-day cash conversion cycle, which meant that from the first outlay to getting in that revenue was 230 days, which is more than half a year, which is not an ideal situation, and why this business owner was feeling the cash crunch. What that meant is it was 11 months from first cash outlay to going cash flow positive on that outlay. And from their business, that meant over $2.3 million had to be outlaid before they received money over and above that amount. So they'd have 2.3 million in the bank to start before they could get back above that 2.3 million, before they're actually making a profit, even though they would show profits significantly before this. So we had to think, what levers and what opportunities do we have here? So we looked at all of them, but obviously the day's inventory outstanding is one that looms large in this particular situation. So we talked to the supplier, we found they had another way to produce it that would reduce the shipping time because it was closer to the coast in the US. So we worked with them. That new solution only took 15 days to ship. We still took the same 15 days to sell. This not only meant that they could sell it quicker, but it meant they had to order less because they only had to order 15 days in advance of that supply need, right? And so they didn't have to order as much inventory. They had less uncertainty as far as seasonality and other changes and moves in the business. They also were able to give us a 15-day term or a term that matched the shipment. So if it took 15 days to ship, we didn't have to pay until it landed in the warehouse. So 30 days to ship, we didn't have to pay for 30 days. That is huge because that buffer between purchase and payment basically meant we didn't have to take and outlay that money until we were ready to sell that inventory. That's a huge, huge advantage. We didn't touch anything on the receivables terms, so those remain the same. We did tighten up some of their collection processes, which allowed them to reduce this number slightly. But in this particular scenario, I'm not going to do that because I don't want to confuse things. I want it to be as clean as possible. So ultimately, with these two changes, we got their cash conversion cycle to 45 days, which is an 80% reduction from their original reality. That 80% reduction is not just great, but it transforms a business. It meant that they went from being cash flow positive in 11 months to being cash flow positive in 2 months. And it meant that they only had to pay out $674,000 before they got cash flow positive and were actually truly making a cash profit. This meant that they ended up with almost $1.7 million in their pocket once we made these changes. And that's a legit increase in the balance in their bank account. That's not some fake number. If they had $1 million before, now they had 2.7 million because they increased it by 1.7. That is huge and transformative. That increased cash balance allowed for them to grow more quickly because they didn't have the constraints that they had on their cash before. So that leads us to the question, what are your levers? Let's turn it back to you. What are the levers in your business that you can pull? So let's break down what these levers look like in action, and then we'll think about specifically you and the questions you need to ask, the things you need to look at. So in the original scenario, you may notice that it took them almost 60 days to get to where they could repurchase inventory. And they could only repurchase inventory once in this 90-day scenario. That's heavily cash constrained. 40 days on a cash conversion cycle looks great, but only being able to repurchase once in that 90 days is cash constrained. So what can they manipulate? Let's talk about the levers that they have. First, we're going to look at their days receivable outstanding, and you're going to see I've taken that from 30 to 0. That means that they would now be requiring that customer to pay for that unit the day that they bought it. We're still paying inventory out as we buy it, but we can rebuy inventory by 6/3 right here, right? We've now already got $1,000 because they paid here and they paid here. We've already got the $1,000 to rebuy. When in the first scenario, we couldn't do that until 6/25. So we've now gained over 20 days back. In this scenario, we were able to repurchase inventory twice, and we actually had enough cash to repurchase a third time because we had over $1,000. If you recall, in the previous one, we could only do that once in that 90 days. So already making a change to this days receivable outstanding has already transformed their ability to turn their inventory significantly quicker. We also have levers that we can pull on the days payable outstanding. I'm not touching the inventory lever here because sure, we can probably speed up how we can pay, but really 10 days to get payments, not bad at all, right? So here I've left receivables and inventory the same, but we change when we have to pay for that inventory. So you notice that now cash goes out until 30 days after that initial purchase of inventory. So we purchase inventory here and we don't see cash going out until 30 days. You also notice we still have those same two purchases. So we have this purchase here, we have this purchase here, but that cash does not come in until 30 days after that initial purchase. So the cash doesn't come in from this first purchase until 6/2, 6/3. The cash for the second purchase doesn't come in until 6/24, 6/25. And so we see zero balance, we pay out for inventory, and then we're back to zero, and then we're back over 1,000 and can pretty quickly rebuy inventory just the same as before. Maybe not as advantageous as the last one, but still a pretty good scenario. Our ability to repurchase here is limited by our ability to sell and to then pay for that right? So if they're paying in 30 days, we need to sell quickly so that we can then get that less than 30 days later and repurchase quickly. So the 30-day term from the supplier gives us a lot of flexibility, but we still have to wait on the customer for that payment. So what if we combined those two scenarios? And that's what we're looking at here. What if we collected payment on day one as soon as they purchased? And what if we waited to pay the vendor, the supplier, until day 30? You can see our revenue and cash line are the exact same through this first section until we have to pay for inventory on day 30. And so we've already gotten over $2,000 in cash before we have to pay for that first piece of inventory. This is a game changing scenario because look at this cash balance grow through this scenario. This is the moment where scaling stops being a cash nightmare and starts being a cash generating machine. This is ultimately what we would love to see, not always doable to this extent, but this is a dream scenario. So when we look at cash in these four different scenarios, you can see how drastically better scenario B and C combined is than all of the other scenarios. In this scenario, the only constraint on growth is your ability to sell. So looking at these scenarios side by side, that negative 20 days means that on average, we're receiving our cash 20 days before we have to pay it out. This is legitimately an infinite growth loop. Insane and awesome outcome to seek after, right? So let's look at the levers that we have and what variables we have and we can pull on for each of these levers. So we have shipping on inventory. We have the shipping time, the days to sell. We have the amount of inventory we keep as well. For days receivable outstanding, we have days to invoice. So if you don't send the invoice immediately, that's going to slow it down. Days to receive the payment. And then on days payable, we have the time to receive the invoice from the supplier, from the vendor, and then the payment terms that they give us. So I want you to go through all three of these and say, for days inventory, how can you decrease your time to hold inventory? Is it reducing the shipping time, the days to pay, the time you hold inventory? You have a lot of levers that you can pull here. For days receivable outstanding, ask, how can you collect money faster from your customers, right? Is it reducing the term? Is it taking deposits in advance? Is it improving your AR process? Even improving the days it takes for you to invoice after the purchase, if you're invoicing, is something that can be an unlock. I worked in a situation where we were able to reduce that from, say, 45 days in some scenarios to less than 10 days in all scenarios. And it completely transformed our cash flow in that business. And then last is days payable outstanding. It's how can you ethically delay your payment to the vendor. We're not trying to pay outside of terms here. We're not trying to play games. We're just trying to utilize those terms in a way that is advantageous for us and in a way that they've agreed with us that is a good way to proceed. This can look like paying closer to the due date or even going to the vendor and asking them for different terms. This can also look like using credit, lines of credits, or even using credit cards to your advantage. We want to go through these three questions and we want to ask these. We want to seriously look at our whole process and see where we have areas to improve and what that may look like. So here's your next move. We want you to map your cash conversion cycle right now. Start optimizing and watch how it transforms your business. I've given two examples here today of how we were able to help people transform their business. And I think the same is available for you in your business as well. The only thing holding you back is the actions that you take here. So I want to ask, did this open your eyes? Did this give you some ideas? Do you see the value and importance of this? I hope that you found it as helpful as I've had other clients find it. And I hope this will be one step in transforming your business's cash flows. Now we're here. We're on YouTube. We got to do it. If you've made it this far and enjoyed this video, please like and subscribe to the channel. This is video number 1. And we've got more stuff coming. We're not stopping here. We're going to keep producing content. So please share this channel, share this video with other business owners you think might gain something from it. We're going to keep releasing regular videos here. We're going deep on concepts like this and other things related to business finance. So again, subscribe so you don't miss those things. Click the bell, whatever that thing is, get reminders. And until next time, keep cash flowing it.